Banks are becoming optional. For most of modern history, banks were unavoidable. If you wanted to hold money, get a loan, invest capital, or move funds internationally, you went through a bank. They weren't just financial institutions. They were financial gateways. But gateways only matter when access is scarce. And access is no longer scarce. The first crack appeared quietly. Fintech. Payment processors like Stripe and Square made it possible for businesses to operate without traditional merchant banking relationships. Peer-to-peer payment apps normalized non-bank transfers. Then came embedded finance. Buy now, pay later companies began issuing credit without you ever stepping into a branch. But that was only phase 1. Phase 2 is happening now. Artificial intelligence is automating underwriting. Credit scoring models no longer require a local banker reviewing your file. AI evaluates transaction history, behavioral patterns, cash flow volatility, and risk indicators instantly. And speed differential matters. Banks traditionally justified their position through trust and regulatory infrastructure. But trust increasingly follows convenience. If a consumer can receive approval in seconds through a fintech platform and a bank requires days of review, the psychological shift begins. This is the hidden vulnerability. Banks are structured around compliance layers. Compliance layers are expensive. Manual review teams, audit trails, regulatory reporting. Artificial intelligence compresses those layers. Compliance automation platforms now monitor transactions, detect anomalies, and generate reports at scale. When compliance becomes software, cost structures change. And when cost structures change, margins compress. Investment banking is feeling this pressure too. Junior analysts once spent countless hours building financial models. Now, generative AI tools can assemble complex valuation drafts in minutes. Senior bankers still make decisions, but the pyramid beneath them narrows. And narrowing pyramids reduce institutional mass. At the same time, central banks are piloting digital currencies frameworks. Whether fully implemented or not, the message is clear. Money itself is becoming programmable. When money becomes programmable, the need for intermediary friction decreases. This doesn't mean banks disappear. It means they risk becoming utilities, infrastructure layers, invisible pipes rather than visible institutions. And infrastructure rarely commands premium margins. Here's the misunderstood opportunity. Banks still control one critical asset: data. Transaction data, behavioral data, credit data. If leveraged intelligently, this data becomes more powerful than physical branches ever were. AI-enabled bankers who understand predictive modeling, risk analytics, and embedded financial systems can reposition themselves not as gatekeepers, but as orchestrators. Meanwhile, consumers are gaining options. Fintech lenders, decentralized finance platforms, digital wallets, cross-border payment apps. Each removes a small layer of dependency. No single innovation eliminates banks, but cumulative innovation makes them optional. Optionality is the structural shift. When institutions become optional, power redistributes. The question isn't whether banks survive. They will. The question is whether they evolve into data-driven platforms or remain compliance-heavy legacy systems. Because in a world where credit decisions are algorithmic, where money is programmable, and where access is instant, friction is no longer defensible. And friction was once the moat. Banks aren't collapsing. They're being redefined. The quiet shift isn't anti-bank. It's post-dependency. and post-dependency changes leverage.